How's it going, everyone? Thanks for joining us for our September webinar. Today we have a little bit of a market update for you guys. We want to jump into some recent news stories and some of the things that we saw throughout Q2 earnings reports, and also have some fun charts and graphs as always. So just to get started with the review of the market vitals, so far in 2025, the S&P 500 is up 12%, which is pretty miraculous considering where we were looking back in April. Over the last month, S&P is up about 2.3%. And as we take a look at some of these other major indices, there are a few things that I think grab our attention here. The Russell 2000 over the last 1 month is up over 7%. So that's an index that tracks a lot of those small cap companies in the US. That has been a big outperformer in the last month. And if we look at the international stock index, that's up almost 3% in the last month. So that has continued to be a strong part of the market, and has been outperforming that S&P 500 so far in 2025. Brandon, what are we seeing in terms of some of those different sectors so far, both in the last month and in 2025?
Yeah, I think if you're looking at the sectors, from a year-to-date perspective, you're still seeing those, large growth. If you look at communications services, that being up 19%. And that's companies, like Meta, Google, and Netflix, which make up about, like 45% of that. But as you go over to the last 1 month, something really interesting is that healthcare, up about 5.5%, where that's really been, lagging behind from the whole entire year perspective, but has making a strong comeback in the past month. And then I think something, another interesting point is, I just pointed out communication services being up 19%, but utilities also being up 13% from a year-to-date perspective. And, a lot of that is coming from, if you look at AI, you might automatically think of, tech, but, utilities of, building out some of the infrastructure and also from, the energy perspective of that output that has to be, coordinated in order for, all the AI. And then also just from, an automation perspective too, of it's not just for tech, but how can I help those companies?
Yeah, absolutely. Yeah, you mentioned healthcare. I think United Health has been one of those companies that's been in the news a lot this year. Was at $600. It dropped all the way to 235, with some news about earnings misses, rising costs, regulatory concerns. And since then, it's actually jumped back up to about $355. So that makes up about 6% of that healthcare sector. And so we've started to see some of those companies in that healthcare sector over the last month rebound from that huge precipitous drop that it had earlier in the year. So that's definitely something to keep an eye on, that healthcare sector, and also small caps, seeing that up 7% in the last month. Those are two parts of the market that have really struggled so far. Is there maybe a changing of some trends in the market, seeing those at the top of the leaderboard this month?
If I can just, this is probably a good time to give a little bit of insight into how we think about markets and methodology when we look at performance. And so I'll just start with the S&P 500. S&P 500 is up 12% year to date and had a really good month last month. That's tracking above the average. If you look over the last 50 years, we can argue over decimal points, but somewhere between 9 and 10% is the average S&P performance over an entire year. 12%, only about 8 months through. That is relatively better than that average. And so to see a high monthly performance with a better than average performance through the year kind of makes sense as we go into the fourth quarter. That doesn't come as a big shock. You guys mentioned the international index being up a solid 3% this month and up 24% year to date. That's way outperforming that 50-year average. And that also doesn't come as a shock to us. With us, the methodology that we use when we see something doing really well, we think that that causes investors to gravitate towards there. They say, why is that up so much? Should I be in that? What's going on? Am I missing out? Is there some fear of missing out that starts to push capital flows in that direction? So we don't dislike seeing something that's up a lot, being up even more than other averages because it's attracting more flows, it's attracting discussion, it's attracting question marks about why is that doing so well. On the flip side, the Russell, if you look at it, up 6.6 year to date, but was up 7% in the last month. That means it was negative at the beginning of August. And then seeing that up 7%, that can sometimes be a sucker move. Because if something's really underperforming, that tells you investors really aren't feeling it. The rest of the market's up, but they're leaving small caps alone. And then suddenly they rush into small caps. And Sean mentions, does that mean something? Is it meaningful? Is it not? It's either one or the other. It tends not to just be like, oh, yeah, it's just going to start performing with the rest of the market. It usually is either it's a sucker move and it's going to go back to being an underperformer, or it's the start of something new. And that's where sometimes people can get tripped up is they kind of fish at the bottom of the lake and get really exciting when they catch one fish. And then they think that's where their line should be the whole time is at the bottom of the lake. Typically, the big fish, they're floating up top. They're the ones eating all the bugs and getting bigger. And so we like to fish at the top a little bit more. We're more comfortable there. That tends to be a healthier place to be. That's also true when we drop down to the sector performance. The communication sector being up 6.4 is a much more comfortable reality for us to see and jives with our investment style more than guessing when the healthcare sector is going to suddenly pop 5.5% from being down year to date before that. That for us is a tougher gamble versus going with the winning hand. So just to shine a little light on when we see this stuff, how do we process it? How do we look at it? That is one of the ways that just looking at something as simple as two performance numbers, you can start to pick away at, what makes sense, what might be a place to look at, what things you want to kind of stick with and seem like more of a sure bet, what things seem like trying to, shoot the moon and are more like a lottery ticket.
Yep, that's
We should
awesome.
probably touch on the money market rate right here too, because the next slide we're going to talk about how
Yeah.
that might not be around for very long.
Absolutely. Current money market rates at Schwab, about 4.16%. And as Jordan mentioned, we're about to touch on potential interest rate cuts that are coming. It's pretty heavy odds that the rates coming, either 25 or 50 basis points. So as those rates come down, the money market rate will also adjust down with those interest rates. So while it's 4.16% today, if we look a month from now, that rate will likely be a bit lower. And if we look at Treasury rates currently sitting around 4% on the 10-year Treasury rate, that's down a bit from where we were last month. And that's because of these interest rate cuts that are likely coming. So if we look at the odds for the September Federal Reserve meeting on September 16th and 17th, we have a 93% chance of a 25 basis point cut and a 7% chance that that's a 50 basis point cut. So we've been at current levels for a while now, and there's an expectation that in this next month, we're going to see that first cut coming. Brandon, what are we seeing also in some of the future months beyond just September? What are kind of the expectations?
Yeah, so after September, there's two more meetings, one in October and one in December. And if you look at the October meeting, there's an 80% chance of another 25 basis point cut. And in December, there's a 75% chance of another 25 basis point cut. So, if you're just looking at those, from a probability perspective, there's a very high chance of at least 75 basis points being cut from, next week towards the end of the year. So something to take into consideration. And I think also, listening to what Jerome Powell has to say, reflecting on guidance moving forward too, if how the odds, change from if he says anything specific or, as we still see more economic data come in, throughout the end of the year.
One other thing, just quickly to highlight, how is the 10-year usually thought of? How do people normally kind of think about what the 10-year rate should be? It's usually a combination of two things. One, market expectations over the next 10 years of what inflation is going to be, plus market's expectations about what growth is going to be in GDP. Inflation's right around 3% right now. That means if they thought that inflation was going to stay at 3% for the next 10 years, they only expect 1% of GDP growth over that same time to justify a 4% yield on the 10-year right now. Market's been really talking about potentially, if we were to roll back the clock about 3, 4 months, we were talking about potentially the 10-year was closer to 4.5%. There was concerns it might go to 5 and even higher, as concerns about inflation were higher with tariffs coming in. What are they going to do? And also just general pricing pressures. There was expectations that the economy and the market was a little bit stronger than expectations are now. So the fact that we see this down at 4% doesn't come as a huge shock in our mind, but there's still pressure that this could go higher. So, I think there's a little bit of premature celebrating by parts of the market that interest rates are going to keep pressing down and keep going lower and lower, based on some of the most recent economic news and what we call contained inflation numbers. Inflation's not really going down. It's just sticking around 3%. It's been somewhere between 2.7 and 3. It's kind of jostling around depending on which part you want to focus on. But it's not at that 2% level that the Fed is really targeting. And we recognize that they've kind of loosened up their target a touch as they're dealing with some of the uncertainties and still unwinding of supply chains and tariff uncertainties. But I think that the 10-year here seems like a reasonable rate. It's kind of in the range that a lot of people speak of, but it's at that lower end of the range for sure. And some people who think it could drop significantly lower are really talking about a deflationary environment, an environment where inflation starts to drop below probably that 2% level. It's kind of hard to see an economy that's going to be prolonged below 1%. I mean, I think that's probably an aggressive take, would be to estimate that the economy is going to be growing, anywhere under 1%. And anyone who says zero is probably selling a book or something.
Yep. Another story this year has been that US dollar weakness. So year to date, US dollar is down about 10%. I think the last few months it's really been floating around that 10% number. So it hasn't gone any lower. It hasn't rallied back. And just looking at it, it doesn't look like it's showing any signs of rallying in the near future. But that continues to be a story behind international markets doing well, is that US dollar coming down this year that can help explain some of that outperformance that we saw on the first slide with international being up 24%, is that US dollar being a bit weaker in 2025.
Yeah, a big rate cutting cycle could put even more pressure on that dollar. I mean, that's normally, all things being held equal, lower
Yeah.
interest rates, dollar goes down.
Yeah. Looking at some of the Q2 earnings highlights, overall for quarter two, earnings were very strong. 80% of companies in the S&P 500 actually outperformed the earnings expectations that were set for them. And I think there's a couple of themes that really show this. AI and cloud computing, that continues to be a lot of buzz in the market right now and where a lot of the optimism is surrounding in markets, and also tariff impacts on corporate earnings. I think they were a little bit less severe than anticipated. So looking at AI and cloud computing, there's a few big examples of that. Oracle, just in the last week here, with a huge earnings beat and also guidance moving forward. They're estimating that by 2030, they're going to have 144 billion of AI related revenue. And that stock jumps 30% just based off their earnings call in the last week, going over some of that optimism that they have around artificial intelligence. We also take a look at Google. They had a really big day a couple weeks ago, up about 7.5%. That was more related to a court ruling that was keeping together their Android and their Chrome business. And it also allowed them to continue to pay Apple to have their search as the default on Apple devices. So there was some thought that maybe Google's monopoly on search engines and smartphones was going to be broken up a little bit. But it looks like they ruled in favor of Google, and that was a nice impetus for the stock price to continue jumping as well. Anything you guys would add to kind of that AI and cloud computing sector of the market that's done so well?
Yeah, I mean, I think with, AI and cloud computing, when you're really seeing the guidance and reports from companies, it's, what is kind of their view on it. Obviously, everyone's kind of been talking about how much they're committing towards that infrastructure. But I think like also another, key point to Oracle is, the different strategic partnerships that companies are having with each other, and how to really build out that, infrastructure in an efficient way, and also having more details on what they're actually, doing in the future, and not necessarily just saying, hey, we're spending X amount on AI generally, but having kind of a clear path of what everything is being used for.
Yep. Yeah, and then that story, tariff impacts on corporate earnings, I think hasn't been as severe. We look at Apple, they've had some key exemptions to the tariffs, and they're planning a $500 billion investment into more US supply chains, which will reduce their reliance on some of that international trade to continue their manufacturing. We also look at Google and Amazon. I think they've offset some of those tariff costs that would have impacted them with more strong growth in that AI cloud computing space. We even look at some companies like Ford, General Motors, which they expected to be pretty heavily impacted by tariffs, but they've had very resilient earnings that's actually exceeded expectations in spite of that. So not as large of an impact from the tariffs so far as we're looking at these Q2 earnings, which has been good for the strength of some of these companies in the market and an impetus for the S&P being up 12% in 2025.
So one of the things that the tariffs have done is they've kind of messed up a little bit of the normal flow of things. So the EV credit, which expires later this month, is a really good example. If you were going to buy an electric vehicle, and right now you get a federal credit from it, but that's expiring in a couple weeks. Um, you're going to buy it now. You're going to buy it when you get the credit. You're not going to wait until the credit expires and then suddenly say, "Oh, I should buy an EV." So, assuming it's a bigger purchase and you've been thinking about it and you keep up with news, you're going to buy it ahead of that credit. And then right after that credit expires, crickets. You're going to see zero EV buying. So you're going to see a big spike and then a drop off. And that's kind of what tariffs do. You're going to pre-buy a lot of your inventory and you're going to, get all that inventory in before tariffs impact your cost, and then you're going to sell, your next multiple months. So if normally you carry like 2 or 3 months of inventory, maybe now you're carrying 6 months to try to get ahead of those tariffs. So the tariffs have kind of made it a little bit hard to understand what the economic numbers or earnings or some of the different factors are because it's changed the way companies are handling timing and how they think about their inventory cycle. And that's something that's just makes it a little bit more challenging to kind of get through the weeds because not every company is doing it. Maybe some companies are doing it more than others. Some companies are going to handle the accounting around it a little bit differently. So it's kind of hard to, parse out exactly what's going on. And I'd expect some blurring for the next couple quarters, if you will, of how that gets processed through. Because companies don't want to look like they're doing that kind of stuff, but in reality, that might be what they're doing. And how they kind of jive that with then how they report earnings or when do they buy it, right? Do they buy it right after the quarter ends so they don't have to report it in Q2, but then show it in Q3? We don't know exactly what's happening with that. So we have to have a little bit of humility as we look at these numbers and say, we're not 100% sure what's happening in the corporate boardroom with how many levers are being pulled right now.
Yep, absolutely. I'm looking at some of those recent news stories. I think we talked about the expectation that rates will be cut in the September rate meeting. This will help put some color around why, looking at job growth, inflation. The August jobs report showed some signs of weakening. The unemployment rate jumped from 4.2 to 4.3%, and the economy only added 22,000 jobs versus the expectation, which was 75,000. And then we look at that CPI number, 2.9% looking over the last 12 months. As Jordan mentioned, it's been floating in that 2.5%, 3% range. And the expectation was that with these tariffs, inflation is going to jump a tremendous amount. We really haven't seen that. It's been sitting in that same 3% range. So between some weakening of the job market and that inflation number really staying in that range of 2.5 to 3% and not seeing a huge jump from those tariffs that were implemented, that's led to this expected rate cut in September. So I think that helps put a little bit more color around why rates will be cut this month. Um, Anything you guys would add to that?
Yeah, I mean, I think going back to the Fed meeting on next week, providing guidance on, how things move forward. If do you see, looking from the jobs data, if that continues to, decline, would there be a greater reason to see the 50 basis point cut in the future? Or even if it, kind of stays steady at where it is, and have the, previous revisions, how does that kind of take into consideration looking forward of how quickly anything else is cut? Or, how long they'll maybe, keep the rate cuts steady at 25 basis points.
Yeah.
I mean,
I-
just picking it apart a little bit more. When tariffs were first announced, a lot of economists jumped out and said how this is going to be very inflationary, if not for the long term, for a short stint. Tariffs are typically passed through to the consumer. It might not all be done at once, but the expectation is that it would be rolled out over time. And I think we would have expected to see a little bit more inflationary pressure from it, or the economists that were certainly out banging the table would have expected to see a little bit more inflationary pressure. And there was a bit of head scratching as inflationary pressure seemed, and I'll use the word contained, because it's almost like if you have a lid on something and it's trying to get out and you're keeping it down. And I think this jobs number kind of told the story of what was the weight on top of that container that was keeping the lid on. And economists, they do surveys and things like that, but they are not really with their thumb on the pulse of the consumer like companies that sell their products to those consumers are. They understand what elasticity is of their different products within their chain of products. Elasticity is the ability to change price without changing the number that the consumers buy. And so if something's very elastic, you can change the price and consumption doesn't change. If it's inelastic, you can't really change that price. Otherwise, the amount that's sold is going to change significantly. So I think what companies found is they didn't have as much elasticity as they thought. They can't change prices without changing the volume consumers buy. And so they've kind of kept prices relatively contained over this period of time and have chosen not to pass through any tariff impact that they've had. And they did it because they probably noticed that their consumers were having trouble. And even if we parse that up even more and say, well, what consumers? The lower end of the consumer scale, the lower income groups, they're having a lot more trouble than the higher income groups. So Gucci is not that worried about it. Gucci is happy to increase the prices of its products. Rolex watches will go up its typical inflationary percent per year. They're not going to miss a beat. But on the other side of that spectrum, if you're going to Kohl's and they are having trouble raising prices because their consumers are impacted very quickly from those price increases. So you're seeing a little bit more dichotomy in the market. This has been a story for a long time, over a decade. Um, and it just kind of continues to play out where, it depends on what part of the market you're in. You're going to really feel the effects of this growth and weakness in the job market, or maybe you won't, and it's business as usual.
Yep, absolutely. And I think it becomes so hard to predict future rate cuts beyond what we're going to see in September. I mean, how many times have we seen or heard Jerome Powell say we're going to remain data dependent and see what the numbers tell us? So as Jordan mentioned earlier, everyone's very optimistic about this rate cutting cycle beginning, and over the next 3 months, rates are going to get cut at least 75 basis points. I think it really depends on what the numbers say over the next few months. Even after the September cut, it's hard to start pricing in that 75 basis points that are going to happen over the next 3 months, without seeing what the jobs numbers are going to look like, without seeing what CPI is going to look like. So it'll be important to stay on top of those items as we continue to monitor the market conditions. Also looking at tariffs, we have had some news come out that the U.S. Court of Appeals upheld an earlier decision by the international courts that the administration's use of tariffs was illegal. And so there's a date set now for the Supreme Court to hear out the appeal of the decision on October 14th. For now, tariffs are going to remain in place as they have been, but that is definitely something to keep an eye on. If these tariffs end up being rolled back because they were deemed illegal by the Supreme Court, this entire saga that we've seen over the last 4 or 5 months could be a little bit more relevant than we initially thought.
It's going to be weird, man. For those who don't understand why this was deemed illegal, basically a tariff is a tax. Congress is in charge of the purse. Congress ultimately has the authority to impose taxes. The president usually does not have the power to arbitrarily impose a tax. The Trump administration used an emergency clause where the president has emergency powers to declare tariffs. I think in World War II, this was done on steel and things, and this is like a wartime effort to keep things domestic that they might need for further war efforts. The Trump administration, I don't remember exactly what they used, but it was basically, if I was to use jargon, it was they're ripping us off emergency. And that's something that, he's been saying they've been doing it for decades. So if it's been done for decades, then we don't need to have an emergency act. We could have gone through Congress, which is a Republican House and Senate, and we could have set up a much more stable form of tariff structure, which wouldn't be as, let's call it, susceptible to legal challenge.
Mhm.
So the tariffs were a little rushed. I think we all kind of felt that on April 2nd, on Liberation Day, when this policy was kind of thrown into action. The markets clearly responded, feeling that it was a little quick and hasty. And, the rollback and everything else has made it seem more orderly, but still the process they've gone by is not the traditional process that you use to enact tariffs that are expected to be long-term and enduring.
Mhm.
This is an interesting case. We'll see how the Supreme Court goes on this, but the two earlier court decisions, they line up, and their rationale is not offbeat.
Mhm.
Yeah. Yeah, so here we have a chart, and it's basically showing three different 30-year time frames of the S&P 500. So you have 1935 to 1965, 65 to 95, and then 95 to 2025. And I thought this was an interesting chart when I came across it. You can see even through each of these 30-year periods, the S&P has annualized 10%. And Jordan brought that up in the beginning when we're going over the market vitals of, typically what has the S&P done and looking at it this year specifically versus, historical averages. But even, as you look at that and have that like long-term mindset, which is important, if you look at any of these time frames and look at specific individual years or even multiple years in a row, there have been large declines in periods of volatility. And I think it was just an interesting chart to show, having that long-term mindset. And while, there might be uncertainty in specific time frames, or there might be a large decline that we're going through, even if you look back in, April when there was a large decline, kind of keeping this mindset as you're thinking about, any, adjustments or changes that may be coming, and, take a step back and kind of put those emotions aside and think logically as a long-term investor of, how have things done over longer periods of time, not just in the moment. And I think that really goes to, time in the market versus timing the market, which is something we, always bring up. Yes, there can be some crazy periods of time, but, it's always good just to take a step back and think about one, where we are, and then also, think about longer periods of time and, not necessarily just the past couple months or just the past year. how's everything really done, over the lifetime and your own investment horizon.
Yeah, absolutely. It's interesting to just look at this list of these different crises that have happened in the last 30 years. And I'm sure in the middle of when these are happening, it feels like there's no way the market can continue to go up through this. And just having those all listed out for that 30-year period and then looking at it at the end of that and saying, wow, the S&P was up on average 10.4% per year over that 30-year period, in spite of all of these different crises that happened, wars that happened, still up 10% through that 30-year period. I think that's pretty powerful to look at. Just knowing that in that moment, it feels like things are going downwards. Pulling it out and looking at that longer time frame is definitely important.
Also kind of speaks to the buy when others are fearful kind of mindset that ultimately makes good investors.
Yeah, absolutely.
That 12.4 seems a little juiced from a 1935 start point. We had the crash in 1929, and I think the ultimate recovery really started in 1938. So you only had 3 years of kind of hovering around there out of that 30-year period. But after that, it was off to the races, baby. And that was, if you just draw a trend line, that whole period after 1929 to 1937, I want to say, was arguably way below trend.
Mhm.
So you were picking up at a great spot there. So not a shock buying in 1935. You
Yeah.
got an extra 2% on your annualized return over the next 30 years. And that just again goes to say when you see a huge decline and you're getting fearful, don't forget to look the other way and say, is this also a big opportunity? Do I have a chance to maybe make greater returns than what has historically been provided just from picking a random point? When you're buying at a significantly below trend line point or lower point that you have a chance to make higher than average returns. And that's something to always just keep in mind. That's something we try to cement into our clients and investors' heads.
Yeah. I think that's all we have for this month's webinar. I think there's some interesting things going on between potential interest rate cuts coming up, some of those sectors that are starting to show some strong performance between healthcare, small caps. Looking at this Supreme Court decision coming up in October, there's some exciting things in the markets to keep an eye on, which is what we're here for. And we look forward to seeing you guys again next month.